Hello traders, Builder EA here with Follow the Bots. Welcome to today's trade strategy review. We'll begin today's review by just touching on the recent recovery rally. In late June, the S&P sold off to 1550. The market auctioned back up above prior resistance, 100 points above the low, 1650. Price auctioned up to the prior multi-year high at 1685 and made a higher high. Today the S&P traded to 1694. The recovery rally is now up 140 points above the June low. The reason for pointing this out is to establish context. Trading, whether you do it from an intraday point of view or whether you do it from a long-term point of view, is about making a profit. It's about gains. As this recovery rally relates to context, you ask yourself, who has profited? Who is going to show the stellar return? The buyer at this low? The buyer at 1600? The buyer at 1650? Or the buyer above the multi-year high at 1685? You cannot forget this when you're trading. You can't get so lost in the moment that you forget and lose sight of context. I posted this chart on the website on Sunday. Here is the prior multi-year high, and after the market traded to the multi-year high, when the high was finally in, the S&P pulled back from 1685 to 1620. I posed the question, what will be the outcome of this high? Will the market continue higher forever? Is that what is possible? Is it somehow going to be different this time? The market is just going to endlessly go up? Or at some point, as with the previous multi-year high and with every other historical multi-year high, is the buying interest going to eventually fade and the market pull back? This is what we mean by context. This is what you cannot forget. Now, if you're new to trading and the amount of capital in your discretionary trading account restricts you to where you can't even entertain the idea of being offsides for more than 1 or 2 points, then perhaps context doesn't mean anything to you. Unfortunately, if your risk management is that demanding that you can't get offsides a point or two without it being the end of the world, you're in a very difficult position, because those who you compete against can be offsides for substantial amounts of money without it having any major material impact upon their account balance. Therefore, if you have a limited amount of capital, your approach to the market has to be more conservative than if you are well funded and can afford to have a higher degree of risk tolerance. As the market moved up through the trading range last week, our upside projected target, the maximum likelihood expectation target, was 1692, and the extreme price excursion target was 1617. We noted that when the market traded at or near 1692, you could sell the market and the likelihood that price would pull back through 1692 at least one time, offering you a minimum 5-point potential profit, was part of the expectation of our Gaussian model. Now, you may not have wanted to sell 1692. That might have created a problem depending upon the size of your trading account. And if that's the case, it's understood. However, look at the outcome to the initial rally to 1692 and the pullback to 1686, and note that you could have sold 92s. There was a 5-point profit target. Even though the market went modestly higher, it pulled back. You could have exited the trade without difficulty, and the two additional subsequent retraces to 1693, the prior high, also yielded a profit. Make note of that for future reference. The same outcome is likely the first time the S&P trades at 1700. A few more points on context. Here at the midpoint of the trading range, relative to the high overnight and the current low at 72, the midpoint 83, is where the S&P broke out during Friday's session late in the day as it rallied up to the 1694 multi-year high. While this is the midpoint of the trading range, it is the weakest pullback target. Nevertheless, when an initial up move is starting, one has to be prepared to go long on the initial pullback at or near the midpoint. The distance between the prior high and the new high is 6 points. Now go back and think about being a buyer at 1554 versus being a buyer at the prior multi-year high, and ask yourself, who's the informed trader? The current trading range is 22 points, equal to a normal cluster. Now on this chart, I've marked it up with numerical references at each of the decision points. And rather than saying, here was a trade here was a trade there, let's just talk about it in the context of the reference points. Number 1, Friday's close. The breakout following the strong up move at Friday's close. This was buy with the expectation that the market would trade up to 1692. You may have passed on that trade. You may not have been interested in that trade, but that in the context of the directional slope of the average, that was something to take note of at the very least. Breakout trades at the open of prior day's closes are not easy trades to take, but that was a decision point. When the market opened on Sunday, one had to be thinking about that. If you were not interested in that and you were looking at the rally up to the maximum likelihood expectation target at 92, the initial uptick pulled back from 92 to 90. If you didn't think to sell the 92s the first time, the market auctioned back up and made a 2-point higher high, but then stalled. And here is where a reference develops, where the slope of the digital filter turns down. While you may not have felt comfortable selling there, and you may have been unsure what the outcome will be, it becomes a reference point when the slope turns down. This is now the inflection point, and regardless of how far the market pulls back, on its return to that price level, one then has to think, what am I going to do? Should I buy the high, hoping it'll go higher? Or is this now an opportunity to sell the retracement to the prior high? Similarly, number 3, a weak reference point, no question about it. But it was in conjunction with the close from Friday. The upturn. If you passed on the trade the first time, despite the sell program's waning alerts and the turn of the average, understood. In other words, no harm, no foul. But when it comes back to the level, it's now a reference point. Now these are all the micro references. The uptick, the retest of the high, the failure to make a higher high, opportunity to go short. The pullback, no turn yet, digital filters sloping down. Here's where the turn occurs. Slightly below the prior low, sell programs waning. Uptick fails to retest a high. Still worth 2 points, but no retest of the high. If held, one has to then exit should price break down below it. Hence the stop location. This was the better pullback target we were hoping for. The midpoint at the 83.84s. But the market didn't get there. Instead, it auctioned down to 85.5. Sell programs waning, opportunity to go long, expecting retest of the prior high, the minor high, minimum expectation, longer term expectation, longer term in the intraday context, retest of the 92s. Rally back up to the high, buy programs waning. This is the aggressive trade we talked about in the room. Minimum expectation, 2-point pullback. You see immediately the 2-point pullback occurred. Then the failure here to go back to the high. If the trade held, it paid more, but immediately got 2 points. This pullback, no particular reference to relate to. Not quite to the inflection point, not exactly a retest of the low, not that attractive of a trade location, no sell programs waning, failure to make a higher high, but the second time down, no lower low, still no sell programs waning. This was so weak today. The rate of trade was unbelievably slow. There were periods of time when price would not change for 30, 40 seconds, just sit there, not change at all. So I'm not trying to tout this as like some great opportunity. Personally, I found it unattractive. I found the whole day unattractive. The trade that I really would have hoped to have seen in the open was a retest of the high. I wanted to sell that, didn't occur. I bought this and had to scratch it, sold it quickly and got my 1-point loss back. Bought this and held on to it. That was my one good trade of the day. Shorted this aggressively and only took the 2 points and had no interest really myself in this. Didn't do anything during these times. Whether you take the trade or you don't take the trade, the purpose of reviewing what happened is to look at the structure and say to yourself, now that I'm looking at it with a clear head, do I feel any differently about it? You may look at it and say, under no circumstances would I be excited to take this trade. I can tell you personally, I still, if this happened to get, even knowing the outcome, right, even knowing the outcome, if this happened again tomorrow, I probably would not be interested in it. Had sell programs waning occurred here, and I had a better feeling that the bots were not going to sell, had sell programs waning occurred here, that might have changed my mind. And I was expecting to see that, but really I was expecting it to pull back to here. I took a late short off of this when it broke down there. But really, I wanted to see it either test here again, that was my minimum, get back down to the 87s. Didn't happen, stopped at 8, touched 8, and went right to hell back up. Had there been more selling in the order flow monitor, high frequency selling, and if I could have confirmed up here that there was indeed on the volume at price chart, high frequency selling or initiated selling, I probably would have felt better about shorting that, but I didn't see it. So missed on that one. Did not take that one. That was another point, but there wasn't any real help in terms of order flow events. There just weren't any. Why weren't there any? Because the freaking market was trading sometimes. I think just segment this out and do an analysis of just what happened there. I don't have that ability. But from memory, counting the up and down ticks, 15 seconds, price not even moving. I saw that a bunch of times. 10 seconds was very common. 30 seconds one time where there was no change in price. So what the hell do you do when that happened? You lament afterwards is what you do. Does it mean that I would want to trade it again? I think the risk greater than the reward. Had the event criteria that I mentioned occur, I would have felt differently. But they did not occur. And the low, I would have been more, I was relatively aggressive on this pullback. But I would have been more aggressive had the market come down more than one time and really showed that there was going to be a low. But this was another touch and go affair. Had the market come down and really worked this and showed me it was going to be a low with a couple of sell programs waning, I might have taken profit early and bought again and been aggressive, expecting it to retest the high. But I got the one trade off. That was all I got. Had the market come back up to this high and press this high a few times with a couple of buy programs waning and high frequency sell surges, I would have been more aggressive at this high. But these didn't quite get there, and no events, slow trickle upticks. That's our review for this Monday, July 22nd, and I enjoy doing this. I hope you find it useful. The point is, again, not to convince you to agree with me, and I hope I never project that. The point is to have a frank, open discussion, talk shop, two human beings looking at what happened, trying to make sense of it, trying to analyze where opportunity might have arisen. That's the point of it. Not to tell you, oh, this was the great take this, but to go through the logic, to go through the levels, to go through the development. And by consistently doing that, we will develop informed opinions, solid inferences, solid strategies, consistent ways to read the market-generated data. That's the purpose of the exercise. You can think of it as deliberate practice, the type of activity that if you were in a sports environment, at the end of the day, you'd sit down with your coach, or if you were the coach, you would sit down with the players and you would say, why didn't we run this play? How come we had everybody in the outfield and you didn't look to throw the ball to anybody there? They were all clear. Wasn't this play part of our strategy book? We have to work on doing this one next time. That's what this is about. An opportunity where there's no pressure on, because the market is, we're not trading the market. We're simply analyzing what occurred. And if you are inclined to do extracurricular activity, I would suggest replaying these. So if we talk about a particular trade, for example, that you see, all right, so let's say out of these trades, there's one trade that really stands out. Not saying that there's any here that do, but let's say there is one trade that really stands out, makes all the sense in the world to you. Master that trade, replay it. Bring your software up, replay it. Say, okay, I see why I was game to buy the low. So let's say you were game, you understood why the midpoint pullback was a level. And now I want to get my timing down so that when I make my decision, I make it at the proper time. I want to use the event alerts to time my entry and then replay it. Just that segment. Forget the rest of the chart. Just replay that 10 times over again until your mind sees it. And as you're replaying it, talk it through. Here's why I'm buying. Here's where it can go wrong. Here's where I have to be on guard. If this happens, I'm going to have to exit. I'm either going to exit with a stop or I'm going to exit on the uptick. I might even, if it breaks hard and it comes back, sell it and try to get, if I took a stop out, try to get my commission back. And you work it out till it's clear in your head, until you own it, until it becomes your trade. Very valuable, very powerful. You do that 10 times, you can close your eyes and you can just see it develop even with your eyes closed. I can close my eyes and I can see setups occurring with my eyes closed. That's how imprinted they become in my brain because of all my chart annotation and because of time spent in replay coupled with factual screen time. So that concludes our trade strategy review for this Monday. Thank you very much for joining us. A pleasure to have the opportunity to share with you.